Members, Namaste, good evening. A warm welcome to you all to this study circle meeting on wealth management in volatile market condition. To develop upon this, we have with us Mr. Sreekara I.P. Now I request our chairperson C.A. Kavita Pramesh to kindly escort the speaker onto dais and welcome him with the knowledge book. Thank you, Chairperson. Members, now I request our Chairperson Kavita Pramesh Madam to give welcome address.
Good evening everyone and a warm welcome to this study circle meeting. And also I welcome Sreekara for accepting our invitation and being here with us. Thank you for accepting that. The idea of this session was not to give tips on how to manage your own wealth, but how do you see as chartered accountants how we can see opportunity in a volatile market and how we can influence and help our clients in managing it better, because we are not experts on wealth management as chartered accountants, and of course our ethical standards do not allow us to do anything on the wealth management. But there are certain things which we as chartered accountants influence and help our clients manage better, which in turn will help our relationship with our clients, to strengthen our relationships. One of the things I was just discussing with Sreekara was he was telling me last month, that is in the month of March, the market was down and every portfolio was lost. So if you had booked some loss, then the current year anyway that could have been picked up, something like that. So there are many opportunities. Unless we are sensible and then watching it out, we may not be able to identify. So that was the idea with which we brought in this session. I would request you all to take this advantage. He has a wide experience. When you hear his profile, you will get to know. So do that. Apart from this, from the brand side, there are a couple of announcements which I thought I should bring it to your attention. One is, all of you are aware, we did this moot court. The final hearing of the moot court for both income tax and GST is coming up on 9th May at the Seshadripuram College, where we have a judge from ITAT, the present sitting Vice President of Bangalore ITAT, is coming, presiding over that bench. His name is Mr. Prashant Maharshi. And apart from that, for GST Tribunal, we have two bench members, advocates. One is Lakshmi Menon and another advocate is Advocate Bhanumurthy. So these people will be present on that day, and where our participants who have been training, they are all training under the mentors now. So they will be presenting their entire arguments, and you will get to experience the tribunals there. Then we have one more exciting and probably an experimental RRC, that is residential refresher course, what we have brought us on cruise. This is on Cordelia cruise for 2 nights and 3 days, where we will be sailing from Mumbai to Goa from 8th June to 10th June. This initially we made it for members, but then the kind of response what we got, and everybody wanted it for family also. So yesterday we opened it up for the family members. We got limited seats, so I would request everyone to take the advantage of it and register. Definitely it will be a fantastic experience. The kind of, it's a 5-star luxury cruise, and it is the Empress vessel which is going there, and around 1,900 capacity, 1,900 people capacity vessel it is. So it is going to be an experience, and along with that we also have a lot of learning. Highlight is that Cordelia's CEO is also attending, sailing through with us, and CEO and CFO are going to give us a talk and give an overview of the entire sailing and cruising business also. So there are multiple things like this, exciting things which are connected with this. So I would request you all to take advantage of that and then register, and also spread this word to your friends also. With this, I hand over to the mic to Vinod.
Thank you, Chairperson, for your address. Before I introduce, I recognize the presence of our Vice Chairman, C.A. Trupad sir. Welcome you, sir. It gives me immense pleasure to introduce our today's speaker. Sreekara I.P is a founder of WNG Group, a dynamic entrepreneur with over a decade of experience in financial services. With an MBA in finance, he leads the company investment strategy, market outlook, and client-centric solutions. Rooted in a legacy of coffee plantation in Chikmagaluru, he blends modern financial expertise with the traditional values. Passionate about the innovation, nature, and fitness and ventures. He also a dedicated family man. About WMG Group, founded in 2011 and based in Bangalore, WMG Group is a leading financial services firm managing assets exceeding rupees 1,000 crores, 4,000 plus clients and serving 500 plus corporate. Built on trust, transparency and integrity, WMG offers WMG Wealth Management, Risk Advisory, Allied CFO Forum, WMG Foundation, and their vision aim to build a holistic ecosystem that supports every stage of client's life journey, delivering value-driven, transparent and customer-first financial solution. With this brief introduction, I present before you Sreekara I.P. Sir, over to you. Thank you.
Thank you, everyone, and it's been our pleasure on behalf of WMG. I would like to thank ICAI for having us here. At WMG, we believe in a holistic growth, and in the whole process, we have named our initiative as Build Brand Bharat. And when we take up any initiative, this Build Brand Bharat is a key initiative that we like to drive. And in the whole process, we do a lot of things that can give a holistic growth. And why I am coming to this when we have to talk about wealth is not just about financial products, but it's a lot more that happens around us that will help you create wealth. So in this whole context, I would like to quickly introduce WMG. WMG is broadly a wealth and risk advisory firm. We hold and a stockbroking firm. WMG has been here for the last 12 years. We manage close to 4,000 crores of assets with 3,000 clients across the world. We also advise a lot of companies in the risk advisory and insurance broking. We are close to about 300 corporates, 300 to 350 corporates is what we advise on the risk advisory. We are stockbrokers. We have just received a stockbroking license a couple of years back, and we are working on building a platform which can cater to the larger mass to buy and sell financial assets. So when I mentioned that we are doing a lot more than just finance, so that the overall wealth of the ecosystem grows, I would just like to show you a quick presentation on what WMG is.
The organizers, WMG.
WMG tries to rekindle that process of encouraging free thought.
WMG Group. WMG. Thankful to the WMG Group.
We are mostly into work, but we take time for doing running, cycling, and mountaineering and many other things.
Mahako, it's a lifetime experience.
Ultimate lifetime experience. What the visit?
Trekking to Kumar Parvata.
WMG Foundation is a group initiative of WMG where we are into various conservation activities.
A small change here can make a big difference. WMG Foundation, through the various companies, they have given us the vehicles also. These contributions are helping us a lot.
Where we took up this huge task of removing Lantana for 1,000 hectares.
I thank WMG, especially Rajesh, Sreekara.
With so much of encouragement, I don't think we will stop doing anything.
WMG does so many such good activities. It's time for us to really realize.
It's our whole Bharat.
Build brand Bharat.
Thank you. The reason why we made this video is generally when people come for wealth advisory or wealth management, they generally think that wealth advisory is where you're having a set of financial products and a group of people or a person, individual known as a wealth advisor or a financial consultant is coming to sell these products. And that is the perception that has been set. But what we have realized is wealth advisory can be, or wealth management can be divided into two parts. One is the primary and the secondary is what we feel. And what is a primary wealth advisory? Primary wealth advisory is where you are not getting into the mainstream products, but you are focused on your own well-being, like your own fitness. If a fit person can probably perform 200% better than a slightly unfit person, mental health, family. There are so many other things that come your way where you can really create wealth. So what happens is people find it very difficult to differentiate between these two, and then they think that when it comes to wealth advisory or wealth creation, it has to be financial product. It is someone else who has to work for us and not we who has to work for us. It's the first, that's the reason we made it primary. The primary part of wealth creation is we. And only when we make it possible, we will create our wealth. And from there it moves to the secondary, where we are not able to perform the way we are when we, as we grow, we will be able to ask the secondary part to create wealth for us. So now I think the first part of the whole presentation is we need to differentiate between the primary and the secondary. Generally, a wealth advisor in a bank, a wealth advisor of a national distributor or any financial product distributor, when he consults a person, the person thinks that this person, the wealth advisor is here to sell me a set of mutual funds, or to sell me a set of stocks, to sell me a set of insurance that he wants to be sold, or which I may be, it is required for me. But on the other side, he doesn't realize that, there could be wealth managers who can also boost their holistic needs so that their wealth gets created over time. So wealth creation is just not money. It is all about creating a holistic well-being so that you become wealthy over time. It is just not that the wealthy person will remain wealthy forever, or an unwealthy person will not be able to create wealth over time. It is a proper balance between the primary and the secondary which will actually make him richer. So now, as I told you, what is a real wealth and a financial wealth? A lot of people actually take some time to realize that the real wealth is just not your car, the house that we buy, or the gold that we have, the silver, and many other things around us. But it is also being healthy, happy, joyful, and I think it takes some time. And when people really feel that the financial wealth is created for them and this is going to come its way, but that's not true. We have to live the real wealth to gain the financial wealth. And that is a broader difference that exists between real wealth and financial wealth. And we all are running, right? We all run so that we see to that we try to make that money quickly and then we can retire. But by the time we retire, we would have made a decent financial wealth. But what has happened to the financial wealth? You will not be able to make it a real wealth. You will not be able to enjoy it because by then it is already, you have lost the energy to really enjoy it. Like for example, I decided to buy a bike when I was 30, but then I thought I need a better bike, and I postponed it by 5 years, then the next 5 years, but now I can afford to buy a bike, but now I don't enjoy it anymore. The roads are crowded, probably I feel it's too dusty on the roads. I'm very comfortable with a car, so I will never probably ride a bike that I wish to. So in the same way, we all plan to run. We wanted to do a 100-mile run, like my colleague Ashwin is here. We always plan to run. And we thought, okay, now we will run for money, and when we have made enough for ourselves, we'll retire and then we will move to running. By then we are already old, we will not be able to run. So now again, if we are able to differentiate between this, live our life as well as make money, is when we have really lived a wealthy life, and you can't wait to be wealthy. I think the wealthy part has to be felt now. A lot of people who come to us tell us that I don't have money now, but when I have, I'll call you. That will never come. They will never make money. It is all that we have to feel that we are wealthy today, understand what are that we can best do for ourselves, and start contributing. I think that will make us wealthy. So, I think as a part of our presentation, what is that we had to keep in mind during volatile scenarios is what I was asked to talk about. And I think when we look at TV or probably browse through internet, last 45 days was the most scariest part for an equity investor. Everything was going upside down. People who had invested even 3 years back, their portfolio went negative. There was FIIs selling all over the place. There was banks which came into the radar, like HDFC Bank came into the radar. Things were just going upside down. So how should people react, and what is the structure that we have to follow so that such volatilities, when such volatilities arise, what are that we need to take into action so that we really need not be bothered about what is happening behind. things might come, volatilities keep happening, coming, going, whatever happens, what is that we need to do in advance, irrespective of time, so that we don't really get bothered with all this, is what I'm trying to cover and keep you all informed. So there are basically 4 or 5 things that we need to keep in mind, so that even if market corrects by 30%, 25%, you really need not be worried, or rather you can just take advantage of it instead of being worried about it. So that's what we are trying to communicate now. So what happened in the last few months? Like Nifty corrected by, I think the index corrected by almost 22%, FIIs sold almost 28 billion, retail SIPs, there were a lot of SIPs which were stopping, but they still continued, which was really scary. We didn't know what is the call that we had to take. Is it the right time to sell? Is it the right time to buy? Is it the right time to hold? So there are certain structures, if we follow, I think we will not be really worried about it. So when it comes to volatility, I think we have differentiated volatility into 3 parts: cyclical volatility, structural volatility, and behavioral volatility. I'm sure most of you would clearly understand what are these things. Cyclical volatilities are, it just comes and goes because people want to have invested, they want to book profit. There is something called short covering that you would have heard. These are cyclical volatilities, when people just want to make profit out of the investment that they have made. They will sell it, they buy it. So these are cyclical. Structural is where there are policy changes, interest rate goes up, interest rate corrects. For every such policy changes, there is a structural volatility that is already there. And then you have the behavioral volatility. What is behavioral volatility? I think, US bombed Iran, and Iran brought down some of the US aircraft. These are things that was not predicted, or we had not expected anything of this sort to happen in the next, probably in 2001, 2021, 22. We never expected US to bomb Iran. It was never expected. Then we were only focused on COVID. We just came out of it. Numbers started going up. Market started going up, getting better and better. But what really changed? The behavioral changes that happened, which was unexpected. So these behavioral changes are unexpected. This can also create volatility. But what can be predicted is fundamental changes. Because there is too much liquidity in the market, interest rates are cut. They try to squeeze liquidity, because of which market corrects. These things can be broadly predicted. But cyclical is where there is something called, you would have seen a technical chart, fundamental chart. When something gets overpriced, underpriced, you can enter the market when it is underpriced, but it's now overpriced. We just have to exit the market. People hold on. And then there's a lot of wave on the upside, then they try to enter at higher values. So these are basically volatilities that are there in the market. And broadly, cyclical and structural, all the research agencies can predict to some extent, but behavioral you can't predict. So what happens to a wealth advisor? Like in Jan 2026, we were all expecting that index has to clock anywhere between 90,000 to 95,000 if all was good, because previous to that 18 months markets were doing terribly bad, and or it was more flattish. It was high time that people have lost patience, and even now if it doesn't go up, then people will withdraw money. By then the gold and silver were having their own run up, so they just wanted to remove their money and put in there. Most of them held back, telling them that, oh no, it's not the right time, now we have already held it for this long, continue to hold it. But something like a behavioral volatility got created because of this war, and then it corrected again. So now what do? How do we react to all this? So, as I told you, last 18 months has been a highly volatile situation for the equity markets. Everything went bad. And then to add to that, there was this war that came, the Ukraine war, FI selling, India markets going down. Now, when it comes to asset class, we have only 4 asset classes: debt, equity, commodity, real estate. Whatever said and done, market has to, you have to get your investment into these 4 asset class, because these are the only 4 regulated asset class from the regulators like SEBI, IRDA, RBI. There are no other asset class, so you have to get in there. But markets are doing bad. So how do we channelize these things is what we need to manage in the in an overall wealth advisory structure. When it comes to wealth advisory, one thing that we have to keep in mind, when equity goes up, gold will generally correct. What happened in the last 18 months? Equity went down, remained flat, but gold and silver went up. And these asset class, either irrespective of their volatility, there is a fundamental growth that these asset class have. It can be equity, it can be gold, it can be real estate, it can be debt or liquid assets. Wherever we are, they have a cyclical volatility. In the short term, when we take as 1 year, 2 year, 3 year, or even 10 years, if you look at the chart, equity growth has been anywhere between 14% to 18%. Gold increment has been anywhere between 8% to 12%. That is the highest. When it comes to debt, it has always remained as 7%. And then real estate, it is very difficult because it all depends on location, where it is positioned, what is positioned, and what kind of real estate. So now, people who are investing for very short term, right? They will be investing for 1 year, 2 year. So then sometimes it is possible that even debt can do better than equity. If you look at the last 1 year track record, equity has just done, I think index of equity has done negative, but debt has given 6%. And in gold, if they had invested, they have made 22%. Sorry?
More than 50-70%.
It depends on what they have invested and when they have invested, but yeah, that's the kind of growth gold has given. On the other side, if they had invested for 10 years, gold has given an IRR of 12%, 6% is what our debt funds have given, and then equity funds have given around 12%. So when we are doing this structuring of so-called wealth creation, we need to understand what is the corpus that is available, first thing. Second thing is, where do we position based on the time that it takes for us to, or to achieve an objective. So that's where we play a role in putting the right allocation, considering the time and the objective, like the goal that has to be achieved. Like for example, a client of ours told us that we have earned 50 crores, but I don't want this volatility of market at all. I just want to be in fixed assets. There's nothing wrong in sticking on to 6% and being there than his BP going up and down, right? So which he doesn't want it to happen. So it is okay. So likewise, we have to make a choice. But what I'm trying to tell you here is, I think the diversification part is the most important part that we have to consider. None of the asset class, if you focus on one asset class, I'm not here to tell you that equity is the best asset class, just put all the money there because it has grown at 18%, or just ignore all the debt because it's only 6%. We need to balance it across, understanding the goals of the assets. So that's what is the most important thing that has to be done. So in the 4 asset class, I'm sure most of you all would know what are the products that are available. Like in equity, you have direct equity, you have mutual fund, you have PMS, AAF, and in debt you have debt mutual funds, you have bonds and FDs. So the most important thing that most of us have to know here is, when it comes to equities, right? We have one is direct equity, the second is the mutual fund, and third is PMS and AIF. How do we differentiate between these three when we have to tell it, or when we have to do it, when we have to invest in these products for ourselves? How do we differentiate? See, direct the end product is the same. Like everyone is investing in equity stocks of multiple companies. In direct equity, you are taking the call. I will take a call that I want to invest in 5 bank stocks or 5 infrastructure companies, and I take a decision to invest and to sell. Based on the gain I make, I pay 12.5% if it is long term, and if it is less than 1 year, I pay 20%. But when it comes to PMS, I think before PMS, when it comes to mutual funds, the fund manager takes the call. Fund manager is regulated by SEBI. He's been instructed on how the investment has to be made and why it has to be made. And most importantly, what people miss out is how it makes a difference is within the fund, if there is any sale and buy of transaction that happens, that is exempt for mutual funds only. Like for example, if the fund size is 10,000 crores, in a year they have bought and sold about 3,000 crores. On 3,000 crores, if they have made a gain of about 700 crores, that 700 crores of money is exempt from long-term and short-term capital gain, which most of us are not aware of, which is actually exempt, which is not even exempt for PMS. So if you ask that delta of tax that we are otherwise we have to pay, which is 12.5% or 20%, will be added to our returns, which is an added advantage in a mutual fund compared to a PMS. So, if you ask me what is a better product in terms of taxation, I think mutual fund has a better edge, because within the fund, whatever trade happens, though we are not eligible to tell the fund manager that you held HDFC enough, you sell it, you buy SBI, we may not be able to tell that. But if the fund manager has taken a call and done it and gained some money, until we sell our funds, we will not be liable to pay any tax. But in a PMS, the fund, though it's a fund, it's managed by a fund manager, whatever trade the fund manager does on behalf of us within the fund will be taxed at regular intervals. Like for example, he sells HDFC, he has made a 20% gain, buys SBI within the fund itself, he will be liable to pay. If it is short term, the applicable tax, he will be liable. That is the most important part when it comes to PMS. PMS mutual fund. Then when it comes to debt is now not exempt anywhere. Like debt versus FD versus any other bonds, I think the taxation is almost widespread and it's almost the same. So you may not be really worried about you putting your money into FD versus corporate bond or even mutual fund, because the tax slab remains the same everywhere. Only thing is in in mutual fund, it is considered as capital gain tax versus an interest income. So interest income will be deducted as TDS and applicable taxes will be there, even if you have not made. But in mutual fund, it will be treated as capital gain and there is no TDS until it is sold. So that might give a small edge benefit to the clients. Like if someone is stuck to stuck to investing in debt, he can always achieve that 0.2%, 0.3% delta difference by investing in a mutual fund versus an FD. Though the returns are there and everything remains constant. So then it comes to the other assets, like you have your commodity and real estate. I think there everything remains constant, but the taxation part remains constant. But in terms of product wise, I think I've made it clear that these are the asset class and these are the products that are available for us. So when it comes to an investor, I again told you that we have to understand what is short term, what is medium term and what is long term investment products. And I mentioned about the products and I mentioned to you about what are the different asset class that are available. It is very important for us to assign the right product to the right customer at the right time, so that he will not be losing money for the objective that he wants to achieve, or the goal that he wants to achieve. Like for example, someone had to buy a car in like 8 months, and he says, let me put my money in equity, and by the time he had to buy the car, his portfolio was down by 30%. Right? So I think those are the situations that should not come. So that's why I think set the goals first, whether it is short term, medium term and long term, and then now I've made it very clear on what are the different asset classes that are available. Under each of these asset classes, what are the products that are available. So you have to identify this, like we have to identify these products and put it into the right product. So that becomes a proper wealth advisory or a financial planning, what people talk about. Once this circle is complete, I think we are all ready to stick to a plan for a short term, medium term and a long term goal. So I think what I meant is when we said that there should be a structure and not panic during volatility is if, for example, we have a person who has set his goals right. For medium term, he had put all his money in the long term assets. For a short term, he has put his money in all the debt assets. And probably 5 to 7 years, he has set his structure for a longer period, long assets. Even in volatile scenarios like this, when the markets corrected the way it corrected in the last 45 days, that person would have not panicked because he has a structure in place. And he would have not even got carried away with this, with the panic that people were trying to create around. Generally what people, I think most of you all would have heard is, I think we as investors buy when markets are high and sell when markets are low. I think that's the pattern that most of us follow, right? And sure, I think you would have heard this quite often. So if we create a structure and stick to a structure and not go with the market flows or volatility, we will not be stuck in this panic situation, and we will not be getting into the whole cycle of selling at high and selling at low and buying at high. So that's the structure versus panic that we need to do. Sorry.
Could you just come to the previous slide? So in case of emergency funds, we would require something which is non-volatile but at the same time liquid, right? So what?
Everybody can? Yeah.
So what are some of the funds which you would suggest which are non-volatile, short-term, liquid, but fairly decent returns?
Okay. See, I'll tell you something which is the trend that is followed now versus what was otherwise not accepted by markets about 7-8 years back. So generally, when it comes to liquidity, emergency funds are funds which you just need of the hour. It's like 1 day, 2 day, right? So predominantly about 5 to 7 years back, people used to park this money in liquid funds or a short-term fund, which is fetching you 6%, and they used to call it liquid funds. And these emergency funds or liquid funds will park there forever. No one used to look back at it, or they say, okay, this is my part of my. But what we have realized is, if you had put your money, for example, in an emergency fund or a FD, if it has completed 13 years of it being there, it would have just doubled. But what we have lost is, if that money had been invested in a diversified equity or any equity asset class or just a balanced fund, it would have become 7 times. The fund value has almost become 7 times. So we have lost it's an opportunity loss, right? So today what a lot of people are doing is, they diversify their portfolio into equity asset class. And nowhere in the world we have a delta difference between equity and the debt being at 10%. The fixed income today in India is at 6%, versus I think a broader equity market has been anywhere between 14 to 60%. Even if you take index, it's 13%. Right? If you invest in a diversified mutual fund like a mid cap, is somewhere around 16%. Thus, this 10% delta is creating 7 times more value after tax than just being twice the amount, right? So it's an opportunity loss. So how do we overcome this? The only way to overcome this is, as of now, there are a lot of NBFCs which fund you against your investments in 30 minutes. Right? So you can just take the benefit of it. Like a lot of apps, like we have an app against your mutual fund in like 10 minutes you can raise funds up to 50% of the value in 10 minutes. So I think that's the liquid asset that can be created rather than we, setting aside and underperforming our overall wealth, thinking that there is an emergency that is going to come and, this funds will be utilized for that.
What is the interest rate for that?
It varies between 9 to 10%.
Not like personal loan.
It's not a personal loan, it's loan against security. Yeah. So I think those are the structures that can be followed rather than we getting into, setting aside the money, because I think 3 to 5 years, a lot of people have kept their so-called emergency fund for 5 years, and today, if you look back 5 years, funds have given 5 years investment has given at least 4 times the return.
But they can go for arbitrage fund or some short-term money market or bond, corporate bond, and then take it back in 6 months and do it and market start growing. When market goes to the peak, they can take the money and then put it in the short term, and the cycle around comes 18 months to 24 months as an average.
Again, when it comes to volatility or wealth creation, I will just talk to you in my
Instead of paying 9 to 10% of interest on this Liam loan against Liam, what we do, maybe you get the tax benefit also.
Yeah, see, that's another structure where the corporates follow, where they invest their money in full, and they take the loan against security against their debt funds only, okay, and at a 9% IRR. Today, a larger bond would cost, and a larger lending would be at around 9%. So what they do is they have 6%. Most of these companies, because of where they stand, this interest will be treated as expense. So at 9.5% also, that 9.5% will become their expense, and the gain of 6% because of their losses that they are incurring will not be under their tax rate.
Not for individuals.
Not for individuals. I think that is for companies. I think that can be done. So I will just finish it off and then we can take it. So I think why I told you that we need not time the market is basically there are two types of investment where we have to be conscious of. One is capital growth and one is speculative growth. Generally, people, when it comes to equity, thinks that we have to make money through speculative growth. There are very few investors who have made money through speculative growth. Like, for example, you would have seen the data, 98% of the F&O investors in India have lost money, and it's about 2% of the investors who have made money in F&O trade. Between 24, 25 and 26, if you take an average, it will be only 4% of speculative F&O investors who have made money, and the 96 have lost money. So what does that mean? Basically, my money has been pocketed by another person and their money has been pocketed by me if I've made money. If I've lost money, it has been pocketed by them. So that is a speculative wealth creation. So do we really need to get into a speculative wealth creation, or should we get into a capital investment where we invest, just ride the wave all through, well diversified, and that keeps growing and we make money out of it. So that's the first choice that we need to make. And for that, if we add a structure to it, then we need not be worried about the volatility, because if you see the overall chart, I'm sure that chart has been presented in a lot of places, where Sensex in 1991 at 1000, then from 1000 it has now touched 78, it had touched 86, then came down to 78. So there are various volatile scenarios, but even just 1 rupee invested, or let me just take about 1,000 rupees invested in index in 1991 is almost around 12-13 lakhs. So that's the kind of growth. So I think that is the overall capital growth. So we have to be very conscious on what is the stand that we want to take. If we are looking at a capital growth or a speculative growth. In a capital growth scenario, 90% of the people make money and only 10% lose money. And this 10% lose money because they realize the loss at the wrong time. They sell it when it is high, and they sell it when it is low, and they buy it when it is high. That's the ratio it falls under. So we all have to be very clear that we have to follow capital growth rather than speculative growth. So like I told you, who is at risk? If we follow capital investment, like capital growth and a structure, we are never at risk. I don't think anyone who follows these two have ever lost money in stock market or any equity assets. Even it could be debt asset. Debt again is volatile. Any other volatile asset, they will never lose money. Speculative investors, I told you the data, 98% of the people have lost money. Only 2% have made money. Capital investor wrongly structured. If you don't have a structure in mind, we will sell it. Obviously, when it is low, we will panic. We will get carried away by the panic and the noise that people are making around. Like if you see, I was just watching the television and it says bloodbath after a long time in the stock markets was what the TV programs used to say. How do you structure? The most important part of structuring is monitoring, which people again miss out. Like a lot of people would have invested in 5 different places, but they don't have one mechanism to control the whole thing in one specific area. Today, government has created NSDL, NSE, where click for button you can get cash statement and various other statements, which can give you your own statement in like 5 minutes, and which will have consolidated investment of all your investment. I think it is important that we know where we are, where we stand at regular intervals. Like for example, everything is looking red on the TV and people say it is end of the story for the stock market. And if you look at your portfolio, it would have just corrected it by 0.5% or 2%. So you need to know about it. That's the other part that we need to add to the structure. Most important part is unrealized gain and real loss. A lot of people think that just because market has corrected, I have lost all the money. But what we have to realize is, for us to regain that money, if we have stayed invested, we need not do anything about it, just stay invested. We take the value which is undervalued and think that we have already lost it, but we just need not do anything just for it to get back. So when you panic and sell a sell is when the whole loss is realized, right? Like for example, if someone had invested when markets were at around 86,000 or 70,000, 80,000, market went down to 72,000. Obviously they panicked because their values have come down by 10-15%. But if they sell it at only 72, then it will be realized loss, right? If they had stayed put, it would have just bounced back and it would be at the value that it is today. Yeah, most of these situations we should not be carried away by these volatilities and we should not do anything. Just stay put, be patient, stay calm and time the right choice that you need to make. So again, the second part to the structure that I want to do, as I told you about the monitoring part, how do we not fear? Like you may say that, oh my God, I put in all my money there, my savings are there, and if you tell me not to panic, how is that going to work? So the reality is that we have to be diversified. I'm not saying that, okay, it has to be diversified between asset class, but even if you are invested in probably about 10 stocks, you will definitely panic. 25 stocks, you will definitely panic. If you are invested in 50 stocks, your panic might be lesser. If you are invested in a fund, you may panic less. If you are invested in 10 different funds, your panic will be much lesser. So the diversification is what makes you panicless. Most important part is volatility is a tool where we have to take advantage of it. Someone very interestingly told when I was hearing to a podcast which was from the US market, which says that first we are here to make money, and how do we make money even when the market corrects? So I think those words actually caught my mind and told that we should be in a situation to take a call when it is lower, when it is higher, when we predict that it is going to go lower, and when we predict that when it is going to go higher. So until now, a diversified portfolio in equity you always had an option to short sell, go short on positions, you could do a lot of things. But in mutual fund that was not allowed because it was regulated by SEBI. Now I am sure a lot of you would have heard of SIF, which the SEBI has allowed people to go, the fund to go short on SIF. They can also take F&O calls on the fund. And again, it has a similar tax like the mutual fund.
What is SIF?
It is a special instrument product, which is a 10-year PMS. 10 lakhs is the minimum ticket size, which is like a PMS but managed by a mutual fund.
What's the full form?
Special investment. Yes.
Specialized in funds.
Specialized investment.
Fund, yeah. Yes. Yeah, I'm not able to get it, sir. It's called SIF. Specialized investment funds. Specialized investment funds. Sorry? So specialized investment fund is like you investing in a mutual fund itself. It's as simple as that. Minimum ticket size will be 10 lakh rupees. It is managed separately, like a fund, but managed separately. The only difference is it will have a fund manager, which allows the fund managers a special permission by SEBI to go short. See, otherwise mutual funds are not allowed to go short. Then they can take, it has to be diversified for sure. They can also take F&O calls on the fund. They can take riskier positions. Their portfolio has to be wider for sure, that they don't allow them to be, like they can't just invest in one company. That mutual fund has a parameter where you can't have more than 1% of your total investment in one company, so there are certain parameters. Likewise, they have set parameters which will be more liberal for SIF to work and give you at least 1 or 2% higher return in terms of returns. Hopefully, if they achieve. If it goes well, it may get bad.
All AMCs are doing it now?
A lot of AMCs have just started it. Like I think Kotak is coming up with the SIF next month. Mirai just started. HTFC SIF they've just floated.
So we don't have a historic.
We don't have a historic. Yeah, I think that's this.
PMS not good. Through PMS it's not possible.
The SIF?
Fund was.
No, the SIF was only. This is a regulatory change that has been brought to facilitate mutual fund to work a bit more in a liberal way, and that's why they have given that minimum ticket size of 10 lakhs.
Is it like a hedge fund?
It's not a hedge fund. It's again a special instrument which doesn't work like a fund at all. It doesn't work like a mutual fund. Yeah, I think the common mistake which people make, which we should tell them not to make during volatile situations, are stop SIPs, sell investments, not keeping liquidity buffers. Like now I told you that we have this liquidity buffer of where we can raise funds against. So we have to create those things and get ready so that if by chance, if there is any situation of liquidity requirement, we can just go all out. So, and definitely not take calls on F&O, stay away from any of these speculative instruments. I think volatile situations makes us react to things. If things were flat, if generally portfolios are moving up, we're not really worried about our portfolio at all. Okay, we are making 14%, 15%. But for some reason, when there is volatility in the market, everyone reacts, everyone wants to jump on it. I think that's the maximum calls that we get. What should I do? Am I in the right place? Why has my fund corrected by 12% versus my friends only by 6%? So those are the questions that come up. I think it's very important that during these situations, we don't react to anything and be very careful of the call that we take, because whatever we plan, we tell most of our clients, when we plan it for 10 years or 15 years, or it has to be planned in advance. Just because there is a message on the phone that things are going bad for the markets, now suddenly Trump has made a new announcement that he's going to bomb another country, he's going to target another country. We should never panic. We should stick to our plan and never be reactive. Reactive is only when we are getting into any of the speculative business. So I think the most important thing is structure first. Let's create the structure from the day we start. Are we doing it for 1 year, 5 years? Does it have a goal? Is it for a retirement plan? Is it the purpose of this is to buy a car, buy a house? I think that's the structure, and work towards the structure to achieve it. Capital versus speculation, I think we have to be capital, we have to have a capital growth. The reason is, if we get into speculative growth, I think that becomes a separate business. We tell everyone that we have limited time and we should not be putting our time into looking at the market every day, open money control, or looking at our broking accounts and seeing what needs to be done there, because we have our own things to be done and monitored. Rather, just put your money so that there is growth, capital growth, we will anyways benefit out of it. And I'm just sharing this as my experience. I'm sure you would also endorse me with this. I just want you all to evaluate how many files that you would have seen in the last probably 10 years or 5 years based on your experience, which have consistently made gains on speculative income. Like if they have done F&O, if they have done share trading on a regular basis, what is that they have made? So with our experience, I think I've come across about 40-50 people, but none of them have made gains consistently for more than 3 years. And most of them would have made losses, or if they take the average of 3 years. I think this is what I had to talk about volatile markets and what is that we need to be careful about while there is volatility around. If there's any questions, I would like to.
You talked about the structure. You never talked about asset allocation. From entire statements, I was looking for asset allocation.
Okay.
So you talked about only goals, financial goals, 3 years, short term, medium term, long term. But all the advisors are talking, I've been listening to Malaysia, Bruce, or Indonesia, everyone will ask me this. First thing you talk about the asset allocation. So why is it missing in your presentation?
See, when it comes to asset allocation, the choice of asset allocation is generally done by the investor. So to arrive at the right asset allocation, there is a risk profiling that is generally done, right? So when we do the risk profiling, there is a set parameter on how we have to arrive at what asset that the investor has to invest. So now predominantly there are 4 asset classes. One is the debt, then you have equity, then you have commodity, then the third one is the real estate. Okay. So only the first asset class though it is volatile, only the returns part will be volatile depending on the situation. But the other three are highly volatile. So the investor has to make a choice on which are the, out of these three asset class, where he has to be allocated. So now when we do a risk profiling, for example, I will ask you about 10 questions, and based on that, those questions, most of us want to make money but don't want to take risk. If we put, and the answer will also follow in the same format, right? But when we look at it, it will say 30% of your investment has to be in debt, 70% has to be in equity, or probably the other three asset class, depending on where the interest is. So now if you put 30% into debt, now that we have a delta of 10% between debt and equity, is it really worth it to be in debt? It's not, right? So I think the choice of asset allocation varies from person to person, and we have to understand the gain returns on various.
Is it not the same even for the financial goals? Short term or medium is not a fixed one. 0 to 1 is not, need not be short term for a 20-year-old. It could be different for 20-year-old, for a 40-year-old, or 50-year-old. Everything depends on the risk profile of the individual, right? So asset allocation is similar. You're right. Yes, if you are high risk, obviously you put it more in debt. If you are low risk, you obviously put it in high yield. And even the ratio of 100 minus age minus 100 minus what are the age? 30, 70 you put it in equity, 70 in debt, and slowly move towards debt portfolio. That's one of the options. So why are not linking the short term with the asset allocation? If it is a short term, why don't you put it more in debt? If it is a long term of 5 years plus, put more focused on multi-cap or mid-cap. It's obvious to mid-cap is last 20 years delivered much better than large cap. At least 5-6%. Take it any HDFC or anyone, take it Volatile, everything is easily 20% if you have premium. Whereas Nifty is hardly 12 or 13%. This is what I was looking for, linking the goals with the multi-asset allocation.
See, I'll just tell you, see, that is where a wealth advisor plays a role. Like what I was trying to tell you and what I want, I'll just continue to that. In continuation to that, see, asset allocation varies from person to person. Okay? The wealth advisor needs to meet the person, understand what are their needs, give these various asset class, and also give them an understanding of the products that are there, and let the client make the choice.
Yeah, obviously client's money, so they should make the choice. He has to take responsibility.
I
fully agree with that. The point here is linking that goals, financial goals with the asset allocation. This is what I felt many of the giants of the financial market, whether it's an Nilesh, whether it's an SI, whosoever you call it. All this,
see, there is no set standard for this. That's what I'm trying to say.
Of course, there is no standard. It's all individual.
So even if we set a standard, like for example, if I meet you and you become our client, if I set a standard to this, it will completely vary from the probably to a person who is just sitting next to you.
I have two questions. Sorry to interrupt.
Yeah, please.
First is that is speculative trade only with regards to F&O, or is it also with regards to short-term trading, day trading, trading within 3 months?
Yeah, I think, see, what does speculative trading mean is basically you're not waiting for the markets to grow. Like you're doing it in a short span. Any trade that happens where there is an exchange of money, it's speculative.
And my second question is, you had told that there should be a buffer liquidity. Of course, it depends from individual to individual. But like sir told about the heuristic asset allocation of like 100 minus CH, etc. Is there a set formula or at least an example of a formula of how much liquidity an individual might calculate that I need this much liquidity depending on the situation?
So, okay, I will tell you another thing on the liquidity part. See, when it comes to wealth creation, what is the wealth that client, any individual has to create is basically 1%. The total wealth has to be equal to his current expenses at the rate of 10% increment. Like for example, today if we are spending about 1 lakh every month, we are spending 1 lakh every month. You add 10% inflation or 12% inflation to that. Incremental value. So in the next 10 years, at the rate of 12%, your cost of expenses will be anywhere between 8 to 10 lakhs in the next 10 years. Okay? So for that 8 to 10 lakhs, what is the wealth that you have to create is basically around 10 crores.
So
How did we arrive at 10 crores is 1% of that money can be used for your regular expenses.
So just to clarify, if let's say 1 lakh per month with a 10% increment per annum, let's say.
Okay.
So 12 lakhs per, then 10%, and I take the annuity payment and then calculate a future value. That then should I discount to my present value, keeping an investment in mind? Let's say, for example, if I invest that, if I in this case I put it in a fund which will give me about 12% as return, 12% return per month. That future value, should I discount at 12% and then take a present value and invest that money, or like how do I?
You have to. So if you ask me how should I build my wealth and what should be my wealth probably when I retire or 10 years from now, then you have to, that wealth value, the value can be anything. See, just because we have to create 10 crores, it's not that we already have 3 lakh SIP that we can just start off today, right? But you can just start with 50, but you can always increase it at an incremental value so that you can reach that number faster.
The 5 days we have to remember.
Sure.
Want to question.
Another step of SIP.
Sorry.
Another step of SIP. What you call.
No, you can continue. Over there. 15 minutes. 15 minutes.
So another thing which of course entire head of all investment gurus Warren Buffett. I expected at least 1 quarter.
Yeah.
Is anyone disagreeing with that? Warren Buffett is well known for it. So obviously it's missing in your presentation.
So I would like to tell it to you now. I think there are 2 rules in investment. The first one is don't lose your money, and the second rule is don't forget the first rule.
Because when we talked about the market is people are selling low and buying high. He said when everyone is greedy, you buy. You don't, you sell. When everyone is fearful, you buy. This is also important.
So I think
Testing to follow.
Huh?
In falling market, we have to enter.
Sorry.
Everyone is greedy, you
The
sell.
market falls, we have to
Everyone is
enter.
afraid of entering.
So in the whole presentation, what we wanted to communicate is that we all have our time, and we should not be spending too much of our time into focusing on where the volatility is, what is happening to our portfolio, is this the current situation or any situation that gets created, what is how we have to react to that. Rather, we create a structure well in advance. We understand what is capital growth, stick to the plan, ignore any volatilities or situations that are coming its way, plan it well, and continue to be systematic and structured so that we don't spend a lot of our time into just looking at wealth creation, wealth building and other things, and focus on our work. So the percentage of our quality time has to get into more into our work, or where we have more space rather than just looking at it.
One of the slides you said you should not check the portfolio every day. So what is the typical timeline we should have to check our portfolios? And what should we do after checking? I mean, how do we do the comparison?
So in our with WMG, what we do is we have a format where we say index returns, the difference between index returns and your portfolio returns depending on debt equity portfolio where it stands. So your base should be index returns. Okay. If index has given 11% and if your investment portfolio has given 13%, then we have done I think it's a decent job depending on where the asset allocation is. Like large, mid, multi-cap, small cap, it is done 13, it's done a decent job. If it has done 16, extraordinary, but it has done 8 and you have 40% in debt, then it's still okay. But it has done 6 and index has done 12, then there is something terribly wrong.
So when should we see the?
You can so there are mechanisms where you can periodically check on.
That would be?
Yeah, there are methods.
1 month, 3 months, once in 3 months we should check. What exactly?
See, you can check your portfolio every day. There is
for decision making,
because you have a consolidated method to see it. But what is the benchmark that you have to set against your portfolio is the most important, right? See, if your portfolio is doing a delta of 2% higher than index, you just need not be bothered about it. Right? There are small changes in the funds that can be done, but that will not matter because they have underperformed because there is something that has gone wrong and they will anyway, bounce back. Things will get better.
So we see the overall portfolio.
Yeah. You see the overall portfolio and keep your benchmark as index.
That is on the monthly basis?
See, that you can check every day.
No, but the comparison, because every day will be very volatile. So should there be every month or once in 3 months I check and evaluate?
See, when you want to make a change, you can do it once in 2 months, 3 months, depending until the portfolio gets streamlined. But what I'm trying to tell you is, there are platforms like WMG platform. It will give you a comparison of your index return and your portfolio.
Which platform is that?
Our own WMG platform will help you create that. So now you know that okay, my portfolio is still done. And when do we reach out to client is when there is a significant difference between index and our portfolio.
Sir, I understand that it's WMG's professional things that you will not share what will be that. If it comes as a client to you, you will share how to allocate. But general crowd thinking is that mostly we talk about equity mutual fund and debt mutual fund. Not much on commodity, gold or other real estate and also stock. In that mutual fund itself, we have the large cap fund, mid cap fund and small cap fund and high risk funds and some of the debt funds, liquid funds are there. In these 5 only, since you are more talked about on the 14 to 18% return, in this combination only it will come. So the expectation is that in this combination, what will be the asset allocation, not on the 14, other 4 or other 2. Generally people talk. Gold as an Indians, everyone will be, whether you like it or involuntarily, gold investment will go in the form of jewelry or gold. But in case of this equity and the debt combination, or it goes with the gold in the initial status, later it will be on the more on debt or more or such type of combination, how we will be doing this, what is the, for example, hybrid, it may have different type of hybrid. Similarly, balance advantage. So in that what combination, people can have this. If you say that only if you come to you as a client, you will say, or generally you can, overall you can talk about 2-3 minutes.
Okay, so what will happen is when it comes to asset allocation, because that question was quite frequently, asset allocation, like I told you, will vary from client to client. One is that. The second part is, I'll just give you an example. Like when it comes to an asset allocation, it is also determined by the goal of the asset that is getting invested. Okay, like I'll give you a couple of cases. One is, we had a client who sold his company and made 100 crores. This client was already 70. If you go as per the asset allocation, the first thing he said is, I'm already 72, I should not take any risk. And I should put all my money in it. Probably because you are here, I'll give you 5% equity. Right. Then he said, okay, then what next? So I think the next question that we had is, what is the objective of this money? Why are we saving this money? He's already 72. He's not going to spend the whole thing. So then we asked him, okay, if that is the case, let's just define what are the 10 things that he's going to do out of this. He's going to give a larger part of this money to his grandkids. He wants, I know, a couple of his kids were married, but a couple of them were not married. So he wants to accumulate some gold for his kids who are getting married. Grandkids, you want to set aside a trust and create some money there and transfer it there. So when we look at it, right, when we look at how long it is going to be there to be achieved, average is anywhere between 2 to 8 years. 2 to 8 years, if I put all that money in debt and tell that these things can still be achieved, it would make justice because the corpus is huge. But on the other side, we would have lost an opportunity for that to be invested in a asset class which can give higher return. Right? So then how do we do it? We told, and then he also was worried about his medical expenses. So he said, okay, let's set aside about 5 crores of money for his medical expenses, which will be in debt, which is liquid asset, because he may not get loan, it will be liquid asset. Why then he came at 5 crores is because the best medication, probably even if he travels to Singapore and blah blah blah, it would cost him about 5 crores. Then we had to create about 5 crores in gold because he had two kids who were getting married immediately and about two grandkids who will be getting married after 18 years. So we created a small trust called a marriage trust and moved a part of that money there and moved it and used it for buying gold. And how we bought gold is through gold ETF because it was 18 years and 3 years. Then what were the other options that were there? We had to buy, all other part was more of gifting it to their kids and grandkids, right? And grandkids, it will be gifted on an average after 12 years. So then we had to take an allocation of putting it into large cap, which was 5 years, with mid caps, which were 12, 15 years, or basically a diversified mutual fund portfolio for about 12 years through a trust. So that's how we structured it. Now, again, to follow a particular pattern and tell you that, okay, let's do 10% in debt, 40% in equity, 20% in gold, and probably 20% in real estate, it becomes a choice and the comfort of that individual on where he wants to be entered. If you ask me how people have to spend, there are a lot of maths, like people say that if I have earned 100, how do I spend it? So we tell them that 30 has to be spent, 30 has to be saved, 30, basically 33 has to be spent, and 33 has to be spent on their own business. If it is a professional and there's not much to be spent on the business, it can be 40, 40, 20. This is on the spend. But when it comes to saving, it's all about the asset class and their comfort. A lot of people are comfortable with tangible assets. Like they say, if I buy a plot of land, I'm very comfortable. If I buy gold and keep it in my locker, I'm very comfortable. There are very few people who still feel non-tangible asset like equity mutual funds, and it's only getting better. But there are very few people who are very comfortable. See, we all probably we know how it works and we are very comfortable with it. But when we go to business class or when we go to people who are in business, 2 tier, 3 tier, 4 tier cities, they're still not very comfortable with non-tangible asset class like equity mutual fund type. They're not comfortable. Even if we help them mobilize about 1 crore of rupees, the next day what they're going to do is just go all out and buy a plot of land which is available. So it is going to take some time for people to move from tangible to non-tangible. I think it's going to take some time.
Just to add to that, I was reading somewhere that US people, when they save, 51% goes into equity and that's where they invest. In India, it's 13% of their overall saving. What is your thought on that? Like, why we are not yet involved in investing into equities?
See, in India, I think the bank FDs are around 450 lakh crores in total. And institutional investment, which is probably mutual fund and all other asset class, will be around 120 lakh crore. That's it. There's a huge gap. And in developed countries like US, Japan, the average is 80. I think US is about 78. In Japan, it is 84:100. They have for 100 FDs, they have 78 as equity or institutional investment. That is because we are still not familiar. Even if you look at the demat account, I think recently we cropped around. People have opened about 20 crore demat accounts, out of which actively traded or individual accounts. Like I have 5 demat accounts. Likewise, I think most of them would have multiple demat accounts. So if you look at one individual demat account, it should be around 4.5 crore demat accounts which are open. Out of which only 10% gets traded. 10% is like 40 lakh getting traded on a daily basis, which is very, very small. We are still not there. That shift is just happening. We are just at the cusp of it.
No,
It is just going to
frauds are below poverty.
Just so I think financial literacy workshops, like I impart this education to people. And if you have, let's say, 3 pointers that you want to share it with others, like who are just starting out in their careers or housewives, in fact, what is that you want to share, like in terms of, because they are always thinking that saving they do, they understand that saving mentality, but saving means FD or accumulating for house. So that's their idea of investment. So
See, I think in simple way, the best way to save is doing an SIP or educating a person to start off with an SIP. Systematic investment plan, it is very, very easy. You can just help anyone to start off with an SIP with just 100 rupees in 5 minutes if they have their Aadhaar card, PAN card and a photo in 5 minutes. If we help them, I think they will be all educated on it and it will just move ahead from there. I think we have people who just started with 5,000 rupees SIP 12 years back and sitting on a corpus of 35 lakhs. In 2012, if people had done 5,000, they are sitting on 35 lakhs cash. Someone who has done 10,000 rupees SIP consistently in a mid-cap fund from 1998 are sitting on a corpus of around 7 crores. I think when we look back, I think most of us would have done it. So I think in a simple way, whatever we may talk, whatever jargon, financial jargon we may use, if we help people to start off with SIP journey, one is they are going to shift their money into equity asset, which is going to give that higher delta. It is well regulated by SEBI. It is managed by the best professionals. The expense ratio is again controlled by SEBI. Everything is taken care of. That's the best thing.
Sir, I have a question. Sir, I've come across some banks and NBFCs offering attractive rates of interest for FDs, like 7%, 7.5%. And one more thing which I've heard is up to 5 lakhs it's insured by DICGC. So is it a good option to sort of keep emergency money in such banks?
See, I think the most important part is we have to be careful on not putting all our eggs in one basket.
Yeah.
Right? So when it comes to NBFC or any of these banks that are there, why are they giving you more interest? Because they are in need of it, right? So when they give you 1% or 2% more, they have to earn 1 or 2% higher.
Yeah.
So that means they are taking a riskier call.
That's true.
They are putting it in a riskier asset. So any fixed asset that you are putting in, I think people fall for that 1 or 2% more, but they will be investing in a riskier asset, which I feel is not the right thing to be done. One is that. Second thing is, I think we should be always careful of not getting stuck there, because again, a larger chunk of your money is with one bank or one NBFC, which is too risky. Like what happened, I think it was there in the news, the National Cooperative Bank was not able to pay off. A lot of people's saving got stuck.
Yeah.
So you think that is an emergency fund, but that should not get into any emergency.
Not all the money, but at least up to 5 lakhs it makes sense, right?
But how does it make a difference when you are 1% delta, taxed at 30%? Does it really make a difference? Yeah, I don't think, as an investment point of view, that is really not going to fetch you much, even in the market.
Good. Also, is there any DIY risk profiling questions which we can ask ourselves to come to a conclusion, or is it really required to, go to a wealth manager to get this done?
See, again, risk profiling, there are a lot of risk profiling instruments that are there on the web. That may not give you the answer that you want. Right? You may say, I want to be 100% equity, but I'm not a risky person. I don't want to take any risk. And the answer that it will give you is 30% equity. And there are a lot of structures that people have put in place. If you say even I'm 10%, I want to play safe, your portfolio will go down by 10% equity. And that 10% in debt, because of the delta again, you are going to lose significantly over a period.
Understood. Thank you.
Sorry, last.
Sure, yes.
Now, AI comes for all that disruption is happening because of AI. Even AI suggests a lot of wealth management and other services. How the future will be on the taking into account of AI? How the future will change?
Yes, so actually, when it comes to AI or any intelligence, right? See, even today, there were about in Bangalore, I have seen that there are close to 1,400 wealth advisors, registered wealth advisors, out of which about 600 are active. Okay. So others are registered but not very active. And you always have an option to take advice from 5 people. Like when Ultra HNI asks us, like as a wealth advisor, I have 5 advisors asking me. Like I have Axis Bank, I have HDFC Bank, I have WMG, I have Anand Rathi and another company who have already come to me. What is that I need to do? So I think the only thing that we tell them is, say you take advice from all 5, you invest part of your money in all the 5 companies. In 2 years, see to that you have only 2, and in 7 years, you see to that you have only 1. Otherwise, it's going to get confusing. I think AI might do whatever. Like she said, is there a set parameter to know how I have to do a risk profiling? It varies quite a bit. Risk profiling is used by individuals to convince on what are the instruments that they have to be investing in, or to understand what is the real need of money, but that is not going to solve the problem. Where it solves a problem is, if now, like what we discussed, we have to build a 10 crore asset book over a period of next 10 years. What is that we need to start from today? How much is the net income that we have that has to get invested in the asset class, and what is the IRR that it has to achieve? If we do that, I think, and we are able to achieve the corpus that we want, that will solve the problem. But in terms of arriving at the product, like should I invest in large cap, mid cap, multi cap? Yes, probably AI can give a answer to it. I don't know if really clients will be okay with it. And now beyond a point, right? Like for example, when you have 10 lakhs with you, you would like to experiment by doing it by yourself. When you have 50 lakhs, you will still try to do it, but you will ask probably an AI agent. When you have 5 crores with you, you would always want a face to it. I think when we look back, when there was something like a robo-advisory that was discussed some time back, will that really come to play? Robo-advisory never came to play, and in developed countries like US and other places, they still depend on individuals for recommendation depending on the tickets.
I just have one question. So we talked about wealth advisor. So are there any pointers that we can keep in mind to choose a wealth advisor? Because it's so overwhelming. Market is full of such individuals. So what is that? And I'm not talking about ultra HNI or HNI, regular people with regular salary levels. Yes.
See, when it comes to a wealth advisor, I think there are a couple of things that we have to keep in mind. One is they have to be transparent on what is their expense, why they are recommending, what are the structure that they are following. Basically their existence, because we are also making our investment for a longer term, right? When we plan, we do it for 5-10 years. What is their long-term plan? So these are the things that you have to keep in mind. But then it is the connect that basically works. Yeah.
When you mentioned about investing in mutual funds, so what you advise your clients like large cap or small cap or mid cap, depending on their risk profile, whatever. So do you advise on ETFs also, or is there any specific reason you are mentioning only mutual funds?
No,
because ETFs also invest in equities only, and again you get industry-based ETFs also you get. So any specific reason?
Okay, for this, it is very important that when we do the categorization of the asset class that we are investing, when we read a book which is more Western driven, right? Like when you read a book which is all about investment from US, they will say that you invest all your money in the top 25 companies which are index funds, ETF funds. But if you look back, what has happened in the last 10-15 years is the eastern part of the world has worked differently. In the eastern part of the world, index funds will give you about 11-12%. A simple large cap fund will give you 1 to 2% higher delta compared to index. A mid cap fund will give you 2 to 4% higher delta compared to index. A small cap fund has given 6% higher delta compared to index. How has this happened? See, I recently came across this book sometime back on Coffee Can Invest, and everywhere it says just invest in index funds, your costs are going to be low and various other things. But that was written by a Western investor or advisor. But the reality is, in the Western part of the world, you see companies, they don't do a backward or a forward integration. Everything is done by them, right? Apple makes their own box. They will not even outsource that. But in India, if Maruti goes up by, sells one car, Exide, which is a mid-cap company, will sell 4 batteries. So if Maruti does well and goes up by 10% because of its sale, Exide should definitely go by 2-3% because of the backward and forward integration that is there. The other part to this is, if sometime back, about 4-5 years back, I checked, if you look at more than $100 billion companies in the US, there would be about 280 or 290 companies which were having a total, that is the market cap more than $100 billion. But in Japan, they had at least 50 more companies, like 50 more in the sense they had more than 350 companies which had $100 billion plus market cap. Likewise in India, then we had only 2 which were going to 4 or 5. So the differentiator is, in India, mid, multi-cap and large cap, small cap always tends to do better because we have dependency on companies which are smaller than in the western part of the world. So wherever you read, they say, okay, you invest in ETF. ETF will give you index returns. But a simple mutual fund, their target is to overachieve index.
Sir, one question, sir. Can you please guide a little bit on exit scenarios from all these investments? And also, can you please compare these listed investments with the private equity? So, how that is good when it comes to these entities?
So, see, when it comes to exiting of funds, yes, definitely we have to exit. We can't stay put. What we have to do is, you have a CAGR calculator, and most of your portfolio will show up a CAGR calculator. If you look at the last 20-year track record of broader index, it's around 16%. And the best case scenario, when the CAGR calculator of your portfolio shows 24-25% returns, that means we have to exit. It's a time that we have to exit a part of your portfolio or clear off all your debts, like you may be running under car loan, housing loan and many other things. Just clear off the debt. And that's the best time. So that can be your mark. Like you can say, if I achieve 20%, I will exit a part of my portfolio, or if I achieve 22%. But definitely not when it is in line or below 10-year average. Below 10-year average, we can still stay put. But when it crosses 10-year average, we can be cautious and we can exit. When it comes to investing in private equity and versus a broader regulated investment products like a mutual fund or any other structure, again, this is what we have done a research or just for our study. 70% of the PMS has underperformed mutual funds. 15% of the PMS has performed in line with mutual fund. 15% of the PMS have overperformed mutual fund, but the average delta is only 2%. So for the 2%, are you really sure that you are part of that 15% or that the 70% is what we are not really sure of? The other part is, you said should we invest in private equity like investment in startup companies, and it's a very risky call, which if the client wants to take it, they can take it. If they are confident, they can do it. But again, when we work backwards, the best performing portfolio in India is probably from Bloom Investors, and they have given 4 times returns with a 8-year fund. 7th year, which took another 1 year to exit. They've given 4 times the return, and that is the best. A simple mutual fund today has given 5.5 times return in 10 years period. So again, it depends on the client, on the call that he wants to take, or where the allocation has to be done. Like when we come across a lot of clients, they say that when I'm investing in startup or when I'm investing in a fund which is into startups, I'm actually doing charity because I want the startup fraternity to work. Then it's okay. But if you look at it and you want to really track and know the history of it, past performance, this is the real past performance. Sorry?
Real estate costs.
Yeah, I think very swiftly I mentioned that real estate depends on location only. It all depends on, see, real estate are basically into 2 forms. One is where the real property gets transferred to you, and the other part is through REIT, where you can make the investment. Today, REIT has really not caught up well because I think after the listing, REIT prices has corrected a lot, and COVID actually dragged it further down. So confidence on REIT as an investment has really not caught up. That is the non-physical form of holding an asset, right? But the physical form of asset is where you buy a plot of land, buy apartment, do various things. What we generally tend to forget is the cost of purchasing, which is the registered tax and various other things, which lands at around 10%. And otherwise, it is the choice that we have to make on what is that we need to buy for holding it. Average real estate growth has been, if it is a residential property, it has appreciated at anywhere between 3 to 6%. If it is a yielding rent, it is adding another 1.5–2%, so it will grow at anywhere between 6 to 8%. A plot of land, if you take Bangalore, it has appreciated at around 12% IRR, a plot of land. Office spaces and other commercial space have again appreciated at around 6 to 8%. REIT is a good choice to make if you don't want to really get into really buying it and managing the whole asset and not having this transactional cost of 10%. We can still enter, but now considering the volatility in the office space, people from working from home, we are not sure what could be the incremental.
Some point on the REIT. See, there is a dichotomy between the real estate in Bangalore and the REITs. We've seen it. Real estate, of course, appreciated at least double in the last 4 or 5 years, probably more than that in some markets. Whereas in the REIT, I have seen hardly, I personally invested also, it's depreciated in fact. I'm surprised by that. And real estate asset is appreciated at least double in 4 years. One thing is on REIT is it gives a return of 10 to 12%. Only of course is taxable. 10 to 12% probably just around that. It is taxable both as a dividend and interest. There are 2 components of interest. It's a good choice. Only thing is not appreciating at all. We have seen in last 4 years. I don't know what's the reason behind this.
I will tell you what is the reason that I feel would be the reason. Basically, REIT, how did REIT come when the REIT price is derived? It is derived at an 8% yield on the property. Like for example, if the rental yield of the property is 8 rupees, the price is fixed at 100 rupees. So 8% yield. So basically what happens is, so for you to derive the IRR or PE of that, this 8% has to become 12%. The PE has to become 12%. Then you have an incremental value. If not, it is just a dividend at 8%. And now what has happened is in the last 5 years, because a lot of companies were shut, 8% dropped to 3% because the average dropped significantly. One is that. The second part is, initially when they did it at 8%, they had not factored in the maintenance cost. But now they have tried to factor in that 8%. So REIT is still not a matured product as such, even now. Sure. I think thank you so much for hearing me, and look forward to stay connected, and please feel free to write to us for any queries. We'll be more than happy to assist. Thank you so much.
That was a very insightful session, sir. Thank you very much for that wonderful session. There are a few small announcements. Before everything to do, there is a small QR code there. Please try to zoom it on your mobile and just fill in a 4-liner questionnaire as a feedback for the event. Make sure this will help us to do more better programs or what we are looking at. Very important for us. Anyone facing difficulty with the QR, you can tell us. Maybe you can just come a little closer, you can catch it better. Okay, done. As we go forward, another major announcement, we have a cruise RRC which is going to come up. First of its kind in Bangalore. So this cruise starts from Mumbai and goes to Goa, and we have a RRC on the cruise. It's a very interesting program, and we have fixed the pricing at very low cost and the market value. So make sure you all join this RRC. There are limited seats, of course, and even family members are also allowed, including kids and children. Make sure you participate in it, and make sure you avail the early bird offer, which will be closing on 30th April. Okay. Next, tomorrow in Sikasa, that is CA Students Association, we have an income tax. Day after tomorrow, Friday, we have income tax session for all the articles. So please make sure you register your articles on the new Income Tax Act session. It's a must attend session for them. Make sure you encourage them to attend. And before I forget, of course, after the session, make sure you have your snacks which are arranged in the canopy next floor. And most importantly, I would like to request CA Kavita Parmesh Madam, our chairperson, to honor our speaker and give a small token of gratitude for such an insightful session. Yes.